Hey there, how you doing? Welcome to the channel. So today I'm slaying some zombies, whatever they are. What are they? Are they zombies in Minecraft? I don't know. But yeah, I'm gonna slay some of those. And then what I want to talk about today is try to get some experience here. And what I want to really talk about today is kind of go over, try to just look at some charts of what was going on in the 70s and 80s with inflation, and then what Volcker did with the interest rates. Because right now, if we look at things, we can kind of, wonder here if, what the Fed is going to do, because we've had this kind of persistently high inflation. And the question comes down to, well, okay, the Fed is going to start backing off their quantitative easing, and they're supposedly as well, going to raise interest rates. And they have certain predictions that, they may raise like rates 3 times next year in 2022. So that's quite a lot, and they haven't raised rates for a very long time. So we're going to see what happens here. But so what we could do is we can try to go back. Now, there can be this whole big debate about, what kind of inflation we're seeing now. Is this equivalent to something that we saw in the 70s? Or was it something that maybe we saw in the 40s? And there's a lot of debate going on right now about that. But I think the way I'm going to look at it, I really don't have data going back to the 40s, and that's pretty long ago. And we had a world war going on, so it's kind of very different in every way imaginable. So where we're going to do is we're going to try to look at some data here, and we're going to look at we go to Fred here, the economic data here. We have in red the consumer price index. So as I've shown before in previous charts, this is the consumer price index, and this is the basket of goods that they're looking at. And so when they report 5%, what they're doing is they have the cost of the basket of goods from a year ago to today, and if it went up, now what they do is month to month. So if you compare the cost of the basket of goods this month to last month, and it went up 5%, or like something like 0.9 or something like that, then it went up 0.9%, or whatever that number. It could have gone up 0.9% or 0.5% or whatever it is, whatever the change in the cost is. And then they annualize it to say, well, if it kept going up for the next 12 months, then on a yearly basis, it would be an inflation rate of, whatever it is, 5%, 6%. So this is the underlying cost. So you can see little periods of time where you had it drop, that was a little bit of deflation. But in the big picture, as I've shown many times, it's pretty much just straight up. Okay, so we have yellow as the consumer price value. The consumer price index, which is the cost of that bundle of goods, and they start it from a particular year, whatever. It doesn't matter. It's all it's a relative thing that's important. So go back to the 50s is pretty flat, and then we have in blue the federal funds effective rate. And what I'm showing here is I've multiplied it by 10 just to kind of get it on the chart. Okay, so when I look here, and if I look at a blue here, so it says the Fed funds effective rate times 10 is 91. So that means the interest rate is 9.15%. Here at this peak, the interest rate is 12.9%. Up here, it goes up to, in 1980, 17.6%. Okay, so 18%, as high as 19% here. So that's pretty amazing. So what's going on is, as we get over to this period of time here in 72, they took us off the gold standard. Now, even before that, you notice that the CPI was starting to creep up from like 70 to 75 here. You see it's starting to creep up. When they took us off the gold standard, it was slow at first, but then it just kind of kept going up. And in the 70s and the 80s, this, was high inflation here. So it was not uncommon to be reporting, inflation in the 8% range, that type of thing. And then really steep going into the end of the 70s here into 1980. It really steep. Look how steep that curve is. And so that's what was going on. Now, the blue line here is the Fed funds rate. So you can see now this effective funds rate is basically, it is the Fed funds rate, but there's some wishy-washiness there. And if you check the two, if you check like what they call the target rate and the effective funds rate, they're for the most part pretty close to each other. They may deviate for a little bit, but not that much. So in terms of getting the big picture, I think it's fine to just look at the effective federal funds rate. And this is basically the Fed funds rate is what the Fed sets interest rates to. So this is their action. This is their active controlling interest rates. So that's what you have to understand. So in the 70s, and it's interesting too, because they had been moving this rate around a lot. You know, here, if I look back in 55, 54 here, interest rate was only 1%. So it's actually very low. And I actually didn't know that. I just learned that. I didn't really know that the interest rate on the Fed's fund rate was ever that kind of low. It's below 1% here, right? The 1% back here in 55. And then it screamed all up to 3.4%. And then interesting, now all the shaded regions are recession. So here you see how get a recession, and they took the rate from 3% and boom, they dropped it all the way down to 0.6%. So that's kind of interesting. In the 50s, they were really dropping that rate. They were really, this is very similar to what we see later on as well. So, and then they brought rates back up all the way up to kind of in this range, 3.98, 4%, let's call it. And then another recession, a significant one in 60, and they bring the rates kind of, they get them back down to 2 point something percent. No, yeah, like 2% range. But they don't go that low as they were in 1954. That's interesting. And then rates are flat and they go all over the place. So now what happens is we see this inflation. Now it's interesting. This is before Volcker. When I looked up on the web, he came in 79, I think April of 1979. So this is before him. The person before him in charge of the Fed is already cranking rates up here. Either they're seeing the inflation. So back here, they must see the inflation going in the red line, and they crank rates up into this range here, which is 9%. So it's like 9% interest rates. And then they quickly have to drop it back down as they go into recession in 1970 here. Then they're low again, and inflation's kicking up. And so they're cranking the rates up again. And here, 74, they get up to 12.9% interest rates. And then they have to back it down because of the recession that it caused, or that was caused by it. And then in the late 70s, you can see they kind of keep rates down, but then they start cranking rates up again. And then somewhere in this volatile mess here, 79, 80, this is where Volcker comes in, and he just starts hammering on this thing. So let's go ahead and zoom into what's going on here. And we're going to zoom in, and then we're going to go look at what the stock market did during this time. So now we're zooming in. So inflation is going up. The red line just continued, the cost of that basket of goods as measured by the CPIs is continuously on a curve going up and to the right. And we have what's really happening here is very interesting. How do I show this? Yeah, so I hope you can see this. You can see how it's highlighted on the blue line, but basically, you know, Volcker came in and they've cranked rates here to 17%. But what's interesting, they're in a recession in 1980, and then they have to drop the rates very quickly down to 10%. So what's really interesting here, if you look at this period of time from 80 to, let's call it 83 out here, this is like wild. What is going on with these rates? They're going from 17% all the way down to 9%. Then they crank it back up within a year to 18, and then they let it come down to 14, and then they crank it back up to 19. So this is incredible. And then they have a very long recession here, looks like starting in 1981. You know, it is very interesting. It's just kind of funny because these are my high school years. I was a freshman in 80, graduated in 84. So all those high school years. So I was alive. I was a teenager, but I had no idea any of this was going on. But so that's kind of what was going on here at this time. You know, they're just cranking interest rates. Now, so let's go figure out what's happening, because you could see that something like this could happen now. And if inflation is high and it's a problem, you could see that they could be in a situation where they want to crank up interest rates some. Now they can't go anywhere near, 17%, because we have so much more debt than we did back then. But I mean, even going to 2, 3, 4% on the Fed funds rate could be significant for an economy with the amount of debt that it has. That's very, very significant. So, you know, if they're in there and they're trying to get the inflation to slow down and they start cranking it up, maybe this would give us something to kind of look at, to kind of get an idea of like, what could we expect if they're doing this? Now, what I would say is, like, if you're running business, if you're doing business and your interest rates are going from like 17%, you know, and they crank up, and all within the same year, they're between 9 and 20%. I mean, you know, just think about that, trying to run a business. Like, how hard is it for you to manage that business? You know, if the interest rates you're paying, and this is the Fed funds rate, with, you know, even if you're a prime customer of a bank, you're a big retailer, a big even like a car company, anything that's capital intensive where you need financing for that. It's very expensive and very difficult to plan. I mean, it's one thing to be like, oh, our rates are going to be consistently high or consistently low. That's better. At least then you can plan. But here, this volatility, rates moving by 10% all within a year, that's pretty hard to deal with. So now let's look at the S&P 500. So now we go here. I don't have exact same data. What I have here is on this chart here is we have the candlestick chart here is candlestick. So this is S&P 500. And then I have the Fed funds rate in the IRX. And they're pretty much together, the black lines here. So you can see this is what we saw in the 80s. We saw that it went from 12%. Left axis is the interest rate. So interest rate going from 12% to 16, going up to 16 something. I think it's even going off the chart there. But it's the same type of thing that you're seeing there. You see that the interest rates are spiking around. Now, this is what gets kind of a challenge because these prices are so low. But here at this point, let's do this one off and let's go ahead and just do some annotation. Okay, so now we're looking at the S&P 500. So the candlestick chart here is the S&P 500. So there we are in 1980 over here, and we can see that the S&P which is on the right scale, which is over here. So at that time, you're at about 110 on the S&P. Okay, you go out and you have a little peak here in 1980. You go up to about 120 on the S&P, and then you come down. So if you think when this spike of rates went from like 12% up to 16%, what happened to the market? Well, it went from 120 down to 100. Okay, so call it a 20% drop. Boom, right out of the gate, you get a 20% drop. And then what's interesting, see now they brought the rates down and the market is already predicting that because it's already starting to go up here, right? It's already starting to move. And then they're bringing the rates down. And so what happens? All right, the market makes a nice move up. But then they start bringing the rates up. So it's kind of this dynamic interaction going on. But so what happens? So now from the low at 100, you made it all the way up to approximately 140. So call it, that's there perfectly, a 40% increase in the market in that period of time. And that's all in 1980. That's from April to call it November, all in 1980. So that's a pretty good move, right? But then now the interest rates were over here. So the interest rates are cranked up here. And now we get into this oscillation of the interest rates going down and like that. Now, what's interesting, the market doesn't really respond that much. I mean, the market starts going down, but it's not like a major move until we get a little further out here in 81. So like at this point here, we'll still call it 130 and we make it down to 110. So another like call it 20% drop here. So what's actually kind of interesting here is what I would say is that during this time, the market is actually not responding hugely. I mean, it is significant. If you look from the high in 81, you were at 140. You went from 140 down to a low of 100. That's a 40% drop over a year and a half, call it. So that would be this range here. So that would just be me taking this range here, the high to the low. So you lost 40% there and you had some volatility. So that's kind of what happened. But definitely looking at it, I mean, it doesn't seem to be a crash or anything like that. I think it's very interesting how this is a similar effect back here. When they dropped rates here, and even though they started to raise them, you did have a move in this early 1980, you did have a move in the market, which was a significant move. So, and then rates over here, I mean, it's just all over the place. Now, what's interesting, now we get a low here at 100, right? And then the rates now are low. So what I'm going to do is I'm going to go over here and okay, so now what I've done is I've cleaned up the graph. I just put the Fed funds rate on there. So if we look at this here, it's kind of interesting, right? Because over here, the rates were 17.5% and they dropped them all the way down to 9%. And that, had a corresponding move. And what's interesting as well is the market moved up, even though rates went from 9% back up until this point, so this is the classic thing, till something breaks, right? They kept raising rates till something finally breaks and the market finally just stalls out and breaks. But what's interesting about it too is, this break here was from 140 to 130. So, that's a whole 10-point drop of the S&P from the 80s, which is a significant amount. So I guess looking at this, what is the conclusion here? Conclusion is, I don't know. I really don't know. So if the Fed has to crank rates up, then, it certainly seems like it puts a lid on the market, puts some down pressure on the market. But looking at this chart from the 70s on the S&P, you're not talking any kind of end of the world. You're talking about, okay, yeah, you went from 140 to 100. That's a 40% drawdown over a year and a half. I mean, that's not great, but it's not the end of the world. And then here, what's interesting, now rates have come back down. They've got the rates back down in 82, and then the market starts really moving, and then it kind of goes into a range here. Now this move is interesting here. It goes from a low of like 100 and it gets all the way to a peak of 70. So that's a 70% move once again in a short period of time. So that's this whole period of time right here. It makes a 70% move and then stagnant. And then here, now they're bringing the rates up again. So here they're at like 8%. That's funny, 8%. And they bring the rates up here all the way to about 11%. And then, but see, they start dropping it and the market just gets right on that. It's like, okay, dropping interest rates, and then the market just goes off. Now it's interesting because they're just dropping rates and dropping it, and the market's just taking off and going. So that's kind of what I see in the charts. I don't really, know what to think about that. I guess there's one of the big problems that you have is that there was not that much debt in the system in the 80s. We didn't have 30 trillion in debt. The government didn't have that much debt. So right now, the government's, is at, so once again, if I just zoom out to the big picture, where are we at now? Okay, so now we'll just zoom out to the big picture. Looking at the bigger picture, we can kind of see that, those rates from the 80s, they just kept coming down. And then they tried to, back in the 90s, they brought them up a little bit. And they actually didn't have much an effect in the market at the time. I guess really the issue now is, can they increase the rates like they did there? No, they can't. So the question is really what's going to happen. Are they going to try to crush inflation? And then I guess the other thing is, did they really crush inflation here? Not really. I mean, it's certainly worth noting that, we could do curve fitting and be like, okay, in this period of the late 70s, if this curve kept going, was it going to really crank up like at a really alarming rate? And if they didn't crank the rates like this and slow things down to, in the end, there's really very little, I don't see any deflation in there. Really, maybe a little right here. It went down a little bit, prices went down, but in general, it just continues to go up. But the rate of how fast it's going up is what's important as well. Now, what's interesting here, what caused this to all occur, them to crank the rates like that, were just really this slope. And I think what's kind of interesting is if you look at the current slope, compare that slope back in here. Yeah, that's a steep slope. And the problem is that, at that kind of a slope, you're losing like 5%, 6% inflation. You're losing a lot of purchasing power very fast. A couple years down the road, your money buys you nothing. That's the problem. Right. And so basically, if you look, that steepness, they basically cut that off and they got the slope maybe a little better as far as I can tell. But look at the slope here that we're in now. Look at that slope. And the slope is the angle, like how fast it's going up. And you can see that that's like almost a hyperbolic kind of curve. And a hyperbolic is where it gets steeper and steeper and steeper. Now, obviously, that's unsustainable. That won't be sustained forever. So in the big picture as well, the Fed funds rate is like zero. We're still at like basically zero in here. And we were at zero from 2010 to 2015, and we still had inflation. We had inflation going up. Okay, so I think the conclusion is it's very inconclusive, but that's how it is sometimes. All right, thanks a lot. Talk to you later.